Hey everyone, welcome back to Corporate Decoder. Today, AKTX just filed an 8K about an amendment to a securities purchase agreement, and I'm seeing a slight shift in their fundraising timeline that is worth noting. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is adjusting how they're bringing in cash, and understanding these behind-the-scenes changes can tell us a lot about their runway. So what we have here is a filing that is updating us on a previous deal. Recall that back in May, Akari Therapeutics, or AKTX, announced they were selling some American depository shares, or ADSs, along with warrants. This was a private placement, meaning they were selling directly to a select group of investors, not on the open market. These ADSs represent a significant chunk of their ordinary shares, with each ADS standing for 80,000 ordinary shares. Now, the key piece of news in this filing revolves around the timeline for how they were supposed to receive the money from this private placement. The deal was structured to be paid in 3 separate installments, or tranches, with different closing dates. The first closing already happened in May. The second was expected around mid-June, and the third around mid-July. But on the 23rd of June, just a few days before the second closing was supposed to happen, the company and the investors agreed to change the plan. They've decided to combine the second and third closings into one single event. This new combined closing finally happened on the 26th of June, just a few days ago. So instead of money trickling in over 2 more months, they got the rest of the funds in one go. This move essentially accelerates the receipt of a portion of the remaining funds. While the filing states no other changes were made to the original purchase agreement, consolidating these closings can sometimes signal a few things. It could mean the company needed the capital sooner than anticipated for operational needs. Or it could be a way to simplify the process and reduce administrative burdens. It suggests they wanted to get all the remaining cash in hand as quickly as possible. An important detail here is that the delivery of the series warrants, which are essentially options to buy more shares later, is still tied to shareholder approval. That vote is happening at their annual meeting on the 30th of June. Until then, these warrants are on hold, which is standard practice for these types of agreements. Now, it is important to understand what this means. This isn't a new fundraising round being announced today. It is an update to an existing one. The company is getting the money it agreed to receive, just on a slightly adjusted schedule. The fact that they decided to consolidate the closings might suggest a push to have all available cash secured promptly. In terms of financial tables, this filing itself does not contain updated financial statements. It is focused purely on the administrative side of the securities purchase agreement. So we don't have new revenue numbers or balance sheet figures to dissect directly from this particular 8K. However, the underlying transaction, the private placement itself, is about raising capital, which is crucial for funding ongoing research, development, and operations. Thinking about the broader context, Akari Therapeutics is a biopharmaceutical company. These types of companies often require significant capital infusions to fund drug development through the lengthy and expensive clinical trial process. Private placements are a common way for them to secure this funding, especially if they are not yet profitable or need to avoid diluting existing shareholders too much on the public market. The speed at which they've consolidated the closings could be interpreted in a couple of ways. On one hand, it shows decisiveness and a strong desire to get the funding finalized. On the other hand, it might hint at an increased urgency for cash. Without seeing their cash burn rate or upcoming milestones, it is hard to say definitively. However, for companies in a capital-intensive sector like biotech, having sufficient cash on hand is paramount to survival and progress. Historically, companies that undertake private placements and warrants often do so when they need a bridge to a significant event like regulatory approval, a major drug trial result, or further public financing. The acceleration of this funding, while not necessarily a red flag, does indicate a focus on bringing funds into the company as efficiently as possible. Looking at similar situations, while this isn't a reverse split or a going concern warning, any adjustment to a financing timeline can be a signal. Consider early-stage biotech companies that rely heavily on cash injections. If they have a critical development milestone approaching, they will move heaven and earth to ensure the funds are available. This consolidation suggests that this funding is important for their near-term plans. My takeaway here is that Akari Therapeutics is tidying up its financing. They are consolidating their cash inflows from this private placement to get it all in hand a bit sooner. It is a procedural update that signals a focus on having that capital secured for whatever lies ahead in their drug development pipeline. What I am actually looking for is the eventual shareholder vote on those warrants. That will tell us more about how Akari intends to structure its capital long term. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. stay decoded. If you found this analysis helpful, please like this video, subscribe for more, and join our Discord. The link is in the description.